Welcome to the Explainer. Today we're looking at Phillips 66. They just had this massive stock rally, but there's a huge mystery here. Are we looking at a permanent structural breakthrough or just a really dangerous valuation trap? Let's find out. Okay, let's dive right into this. To get a handle on the current setup, we first need to understand what Phillips 66, trading under the ticker PSX, actually is. And look, if you're just viewing them as a basic oil refiner, you are completely missing the bigger picture here. They're a Houston-based downstream energy powerhouse. Yeah, sure, refining is their historical bread and butter, but they are heavily diversified. We're talking massive midstream logistics networks, a highly lucrative chemicals joint venture, plus the sprawling marketing, specialties, and renewable fuels business. And this structural diversification, it's absolutely crucial. You know how the energy market is? It's notorious for these violent, aggressive boom and bust cycles. By spreading their bets across multiple points in the energy value chain, they kind of insulate themselves. They aren't entirely dependent on the wild swings of just one single commodity price. And speaking of those wild boom cycles, let's talk about their second quarter of 2026, $3.8 billion. That is their adjusted earnings for just a single 3-month period. I mean, really let that sheer scale of cash generation sink in for a second. It was an absolute blowout. It took the whole market by storm. What Phillips 66 showed us here is that when the stars perfectly align in the energy markets, their operational leverage is capable of capturing an oceanic amount of profit. They didn't just casually beat Wall Street's expectations, they completely shattered them, basically flooding their own balance sheet with cash. Now, to put that $3.8 billion into perspective for an individual shareholder, that translates to a stunning $9.41 in adjusted earnings per share in one quarter. No way, right? So how exactly do they pull that off? Well, their realized refining margins more than doubled, absolutely rocketing to over $24 per barrel. To really grasp how wild this is, you gotta realize the gap between the raw crude entering the facility and the actual refined fuel you pump into your car was historically wide. Every single barrel of crude oil they processed, whether into gasoline, diesel, or jet fuel, was just throwing off this exceptional, totally unprecedented amount of cash. But here is where management actually earns their paychecks. They didn't just take that massive windfall and go on a reckless expansion spree or blow it all. Instead, they aggressively repaired their balance sheet, paying down total debt by $6.6 billion. That is a gargantuan reduction, bringing their net debt down to roughly $16.5 billion. For long-term investors, honestly, this kind of discipline at the absolute peak of a cycle is exactly what you want to see. By stripping away all that heavy interest expense and lowering their financial risk, they are structurally de-risking the equity. Plus, it frees up so much future cash flow for things like reliable dividends and aggressive share buybacks. So let's move along and see how this all builds into the broader business model. Think of this as the PX engine. You've got refining, that's the high-octane, highly volatile profit driver. Then you have midstream, handling the pipelines and storage. You've got chemicals, which captures value even further downstream. And finally, marketing, specialties, and renewable fuels, which directly interface with commercial and retail demand. It's the synergy between these 4 distinct arms that creates the immense operational leverage we just saw in that Q2 blowout. Basically, when refining margins explode, the other segments help catch, stabilize, and compound that value across the entire corporate structure. Now, we really need to contrast the 2 biggest pieces of this puzzle, refining versus midstream. Refining is, well, it's highly cyclical. It's intensely sensitive to global commodity prices, geopolitical shocks, sudden macro demand shifts, the whole shebang. It can print billions one year and then completely struggle the next. Midstream, on the other hand, acts as Phillips 66's hidden stabilizer. These midstream operations are largely based on long-term, fee-based contracts. It's kind of like a toll road model. Whether oil is trading at $50 or $100 a barrel, they get paid a steady fee just for moving it through their pipes. That provides this crucial bedrock of stable cash flow, which heavily protects the company's dividend when the refining cycle inevitably turns south. And you know what? Phillips 66 is actively doubling down on that toll road stability. They actually just approved the $5 billion Western Gateway Pipeline project. This is a massive 1,300-mile joint venture with Kinder Morgan and HF Sinclair, targeted for completion in 2029. It's designed to connect fuel supply routes directly from the Gulf Coast out into Arizona and California, moving up to 230,000 barrels every single day. And because it's supported largely by long-term take-or-pay contracts, this project effectively cements their long-term infrastructure. But more importantly, it acts like a massive insurance policy. It's a steady, predictable river of fee-based cash flow specifically meant to offset their own volatile refining wing. But getting back to that refining side for a second, a huge part of that Q2 blowout wasn't just, getting lucky with commodity prices. It was ruthless operational efficiency. Phillips 66 achieved an incredible 96% refinery utilization rate. Now, the underlying math here is absolutely critical. Refineries are these massive, highly capital-intensive beasts with enormous fixed operating costs. When you can push utilization all the way to 96%, you're spreading those heavy fixed costs over the absolute maximum number of barrels produced. That mathematical leverage right there, that's the secret sauce. It's exactly what transforms a reasonably good margin environment into phenomenal record-breaking profitability.
So the crucial point is, we might actually be looking at peak cyclicality, right? That extraordinary Q2 environment wasn't necessarily the result of some permanent structural shift in global energy. Actually, scratch that, it was heavily driven by temporary geopolitical fuel disruptions. We're talking tensions, choking supply routes, and sudden constraints on foreign refining capacity. These events effectively starved global supply, which artificially tightened the market and pushed margins literally to the moon. It was a perfect storm. And while Phillips 66 executed flawlessly to capitalize on it, let's be real, perfect storms just don't last forever.
And this brilliantly illustrates the danger of extrapolating short-term results in a highly cyclical industry. Look at this. For the entire 12 months of 2025, Phillips 66 generated an adjusted EPS of $6.44. Then, in just one single quarter, Q2 of 2026, they printed $9.41. Let me repeat that. A single quarter completely eclipsed the earnings of an entire previous year. This visually proves the extreme cyclicality at play here. If you buy the stock today, assuming $9 a quarter is the new normal, you are walking blindfolded straight into the valuation trap. Now, to be completely fair, there is a very strong structural bull case that balances this out, and it's called structural scarcity value. Simply put, it is virtually impossible to build a new large-scale refinery in the United States today. Environmental regulations are exceptionally strict, the capital requirements easily run into the tens of billions, and when you combine permitting challenges with fierce community opposition, new builds are basically a non-starter. So what does this mean? It means the existing high-quality assets Phillips 66 already owns are operating in a protected, closed market. And a moat built by absolute regulatory and capital constraints is arguably one of the strongest defensive moats a business can possibly possess. However, the normalization risk remains the biggest bear case hanging over the stock. Think about it. If those temporary geopolitical tensions ease up, if global supply chains adapt, or if new capacity over in the Middle East or Asia comes fully online, the current hyperinflated refining margins are going to collapse right back to historical averages. If that happens, that amazing $9.41 quarterly EPS could easily plummet back to a normalized $3 to $4 range. And this right here is the exact moment retail investors often get trapped. A stock that looked incredibly cheap based on a backward-looking PE ratio suddenly becomes dangerously expensive as the underlying earnings rapidly evaporate. Now, what's really interesting about this slide is what happens when we map out a realistic 3 to 5 year valuation framework based on those normalized earnings. A pretty stark picture emerges. We aren't looking at one crazy quarter here. We are focusing on cycle averages. In a bear scenario where earnings normalize to say $10 to $12 a year, the stock could easily trade down to the $90 to $130 range. In a base case, it sits comfortably around $155 to $210. The bull case, which, keep in mind, requires structurally higher margins to actually stick around permanently, puts it at $235 to $315. This framework perfectly highlights just how wildly sensitive the ultimate stock price is to where long-term refining profitability eventually settles. But listen, even if margins do cool down, Phillips 66 still has multiple distinct levers left to pull for shareholders. First off, if refining margins stay elevated longer than anyone expects, the sheer cash just continues to pile up. But even if they don't, their ongoing aggressive debt reduction continuously transfers enterprise value straight from debt holders over to equity holders. Combine that with aggressive share buybacks constantly shrinking the overall float, which means your earnings per share can grow even if the overall corporate earnings stagnate, and you've got a solid recipe for resilience. Add in the quiet execution of midstream expansions like Western Gateway and the persistent optimization of selling off weaker assets, and you can see why the company remains structurally sound regardless of where we are in the cycle. Pulling all this analysis together reveals a pretty fascinating split in our investment scorecard. The underlying business itself is an absolute powerhouse. Business quality and that newly repaired balance sheet, they earn an 8.5 out of 10. Cash generation and shareholder returns are a phenomenal 9 out of 10. I mean, this company is literally a cash machine right now. But that high price tag drags the valuation and risk score down to a 6.5, which brings our overall score to an 8.1. So it's a phenomenal, finely tuned financial engine, but at current levels, you are absolutely paying a distinct premium to drive it. So, Where are the concrete strategic buying zones? Look, with the stock recently trading up near $232, aggressive chasing here is incredibly dangerous. The market has already priced in a whole lot of that Q2 perfection. Above 230, your absolute best asset is patience. Just let it come to you. If it drifts into the 210 to 230 range, it becomes a solid hold, or maybe a spot for selective dollar cost averaging. But the real margin of safety, that opens up below 210. That $190 to $210 window is a prime accumulation zone, and anything dipping below 190 becomes highly attractive for a resilient long-term entry. At the end of the day, Phillips 66 is undoubtedly a cash-generating compounder. It's got immense scarcity value and a rapidly bulletproofed balance sheet. But in heavy commodity markets, timing and price are absolutely everything. So as you analyze this company for your own portfolio, you have to ask yourself one final critical question. Will global refining margins somehow hold at these historic, unprecedented highs, or is the inevitable cyclical collapse already on the horizon? The answer to that question will determine whether this is the energy play of the decade or just a textbook valuation trap.